inflation rates have sustained confidence and the global economic recovery this year, even with further waves of COVID-19 virus expected. Recoveries in emerging market and developing economies will continue to lag those in advanced economies, in large part due to a slower pace of vaccinations. The virus, however, remains one of a series of current risks to South Africa's economic growth outlook that includes rising inflation, weaker commodity export prices, stagnant investment, and the longer-term impact of scarring from the pandemic and the July unrest. The International Monetary Fund forecast for global gross domestic product is 5.9% in 2021, slowing to 4.9% in 2022. The SABC forecast for global growth in 2021 now sits at 6.3% and is unchanged for 2022 and 2023 at 4.4% and 3.3% respectively. GDP growth in our trading partners in 2024 is forecast to be 2.7%. Global economic conditions are now less supportive of emerging and developing economies than in March of this past year. Although policy settings in advanced economies remain accommodative, considerably higher global inflation and rising uncertainty about the normalization path for interest rates continue to cause financial market turmoil and capital flow volatility. Risk aversion in financial markets has increased. Economies that failed to take advantage of improved global prospects or to reduce large macroeconomic imbalances remain vulnerable. While the domestic economy grew strongly in the first half of 2021, the second half of this year is expected to show mixed results. Overall, we forecast the economy to grow by 5.2% this year, revised down due to the larger negative effect on output than was previously estimated from the July unrest and other factors. Our revised estimate for third quarter economic growth is negative 2.5% compared to the previous negative 1.2%. For the fourth quarter, we expect a GDP outcome of 2.6% compared to the previous 1.6%. Despite these quarterly revisions, the annual growth rate in GDP for 2021 reflects a healthy bounce back from the economic effects of the pandemic. However, in the next 2 years, economic growth is expected to align with a low rate of potential growth. GDP is expected to grow by 1.7% in 2022 and by 1.8% in 2023, unchanged from the September forecast. GDP growth in 2024 is forecast to be 2%. The July unrest, the pandemic, and ongoing energy supply constraints are likely to have lasting effects on investor confidence and job creation, impeding recovery in labor-intensive sectors hardest hit by the lockdowns. High export prices are expected to fade, perhaps faster than previously expected. Very weak job creation will moderate household consumption. Investment will remain constrained by the high risk of further load shedding and ongoing uncertainty. The faster vaccine rollout presents some upside risks to the growth outlook. Overall, and after revisions, the risks to the medium-term domestic growth outlook are assessed to be to the downside. Compared to the September meeting, the output gap is broadly unchanged over the forecast period. The current account surplus remains substantial, but is expected to be significantly smaller than our previous projections at 3.8% of GDP in 2021. Prices for important commodity exports such as rhodium, iron ore, coal and platinum have decreased in recent months, some sharply. Oil prices have increased by about 68% year-to-date compared to the 2020 average price. Alongside higher prices and stronger demand for imported consumer and investment goods, the commodity and oil price movements imply a smaller trade surplus. Whereas a current account surplus of 0.7% of GDP was forecast for next year, we now expect a current account deficit of 0.6% of GDP. Although fiscal risk has eased, financing conditions remain volatile and the yield curve for rand-denominated bonds remains steep. 10-year bond yields have shown greater sensitivity to global and domestic factors and sit at about 9.5% at present. For much of the year, generally favorable global financial and economic conditions and strong commodity export prices strengthened the currency above its long-run equilibrium level. In recent months, increased uncertainty about global inflation and policy settings, with a moderation in the terms of trade, have however contributed to a weaker rand exchange rate. Since the September meeting, the rand has depreciated by 5.9% against the US dollar and now sits below its equilibrium level. The implied starting point for the rand forecast is 15 rands 10 cents to the US dollar compared with 14 rands 47 cents at the time of the previous meeting. With ongoing global supply shortages and strong demand, a wide range of prices continue to accelerate, including raw materials, intermediate inputs, and food. Some of these price increases have passed through to consumer prices in major economies. Our estimate for inflation in the G3 was revised higher for 2021 to 2.9%, to 2.4% for 2022, and remains unchanged at 1.8% in 2023. For 2024, G3 inflation of 1.6% is forecast. Oil prices are revised up for this year, and fuel price inflation is higher at 17.6%. Local electricity price inflation for 2021 remains at 10.1%, while the forecast for 2022 and 2023 is revised up to 14.4%. For 2024, electricity price inflation of 10% is expected. The bank's forecast reflects higher headline inflation for the fourth quarter at 5.3%. For this year and the next 2 years, headline consumer price inflation is revised slightly higher to 4.5% for 2021, to 4.3% next year, and to 4.6% in 2023. Headline CPI for 2024 is expected to be 4.5%. The forecast for core inflation remains at 3% in 2021 and is slightly lower at 3.7% in 2022. Core inflation is expected to be slightly higher at 4.4% in 2023 and reaches 4.5% in 2024. While the economy continues to expand over the forecast period, core inflation remains subdued by low services price inflation, modest unit labor costs, and exchange rates. The risks to the short-term inflation outlook are assessed to the upside. Global producer price and food price inflation continued to surprise higher in recent months and could do so again. Oil prices have increased sharply, with current prices well above our forecasted levels for this year. Electricity prices are higher throughout the forecast, and with other administered prices continue to present short and medium-term risks. Given the moderate medium and long-term inflation projections set out above, a weaker currency, higher domestic import tariffs, and escalating wage demands present additional upside risks to the inflation forecast. Average surveyed expectations of future inflation remain at 4.2% for 2021 and 4.4% for 2022. Market-based surveys expectations for inflation for 2021 are broadly unchanged. While the committee expects inflation to stay close to the midpoint over the forecast period, inflation risks have increased and the level of policy accommodation remains high. Against this backdrop, the MPC decided to increase the repurchase rate by 25 basis points to 3.75% per year with effect from the 19th of November 2021. 3 members of the committee preferred an increase and 2 members preferred an unchanged stance. The implied policy rate path of the quarterly projection model indicates an increase of 25 basis points in the 4th quarter of 2021 and further increases in each quarter of 2022, 2023, and 2024. As usual, the repo rate projection for the quarterly projection model remains a broad policy guide, changing from meeting to meeting in response to new data and risks. Given the expected trajectory for headline inflation and upside risks, the committee believes a gradual rise in the repo rate will be sufficient to keep inflation expectations well anchored and moderate the future path of interest rates. Economic and financial conditions are expected to remain more volatile for the foreseeable future. In this uncertain environment, policy decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on second round effects. Current repurchase rate levels reflect an accommodative policy stance through the forecast period, keeping financial conditions supportive of credit demand as the economy continues to recover. The bank has ensured adequate liquidity in domestic markets and will continue to closely monitor funding markets for stress. In addition, regulatory relief provided to banks continues to support lending to households and firms. We wish to emphasize once more that better anchored expectations of future inflation should keep interest rates lower for longer and can be realized by achieving a prudent public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage growth in line with productivity gains. Such steps will enhance the effectiveness of monetary policy and its transmission to the broader economy. That concludes our statement. This is the first press conference that we are hosting physically in the Reserve Bank, but the journalists are not in the room. The questions will come online, and Ziyanda will then field the questions, and I will then direct them as appropriate to the other MPC members.
Thank you, Governor. There aren't any questions yet. If we can please give the media a moment to type them.
They are still typing, yeah.
Yes. Okay. Okay. I've got a couple of questions here, Governor, from Mike Cohen from Bloomberg. His first question is, can you please provide detail on how domestic factors versus external risks, such as Fed tempering, continued policy normalization in other emerging markets, played into this decision? His second question, does the MPC still prefer to move up in increments of 25 basis points? Under what conditions would you move in larger increments? Okay. Then I've got a question from Ed Stoddard from Business Maverick. With the onset of extensive load shedding this quarter, is there a risk that your growth forecast for 2021 could be revised down further? Thank you, Governor. I've got a couple of questions from Alex at Reuters. I'd like to, okay, are fuel prices the greatest short-term risks to inflation outlook? And his second question is it possible to say how long the transmission mechanism from a rate hike normally takes? I.e., given that you've hiked today, will you have to wait and see at the next meeting whether the impact of today's move has fully materialized? His third question, what are your expectations for domestic economic demand? We know the economy has been supported by bumper global demand for South Africa's commodity exports, but if that fades, what is the prospects over the medium term that there'll be growth from domestic drivers? Thank you, Governor. Those are all the questions for now.
Thank you very much. Mike, in the statement we spell out both domestic and global factors that are driving the inflation trajectory. We have not weighted them. We just said that these are all the factors that we took into account. The forecast that we place is underpinned by a series of assumptions which are published with the statement. And it spells out what our international assumptions are and what our domestic assumptions are. And it also then the forecast is captured in the statement. So the statement is giving an assessment of both global and domestic factors that would impact on inflation. And you ask the question, to what extent have we taken account of tapering in the advanced economies, and to what extent have we taken account of the normalization path there? Well, tapering has taken place. Normalization of policy has not yet taken place in the advanced economies. Our assessment has always been based on what we see as the channels through which the normalization of policy would affect us as a small open economy. And the view that we have taken is that it will mainly come through two channels. The first channel is a financial channel, that when that normalization takes place, there is bound to be a repricing of financial assets. And secondly, there is going to be a realignment of exchange rates. And to the extent that this realignment of exchange rates and repricing of financial assets takes place, there would be a movement of capital across boundaries. If such a movement of capital results in outflows taking place from the emerging markets, including South Africa, and the exchange rate gets affected in the process and is realigned with the advanced economy currencies, we would do what we normally do, which is this of a temporary nature, or is this of a permanent nature, meaning does it lead to second round effects? If it is just of a temporary nature, we will look through the shock. But if it is of a permanent nature and leads to second round effects, our reaction will be to those second round effects. To be clear, we didn't take this move to try and preempt what the advanced economies will be doing. We took this move based on our assessment of the domestic and global economic conditions and our own forecast of what the inflation and growth outlook would actually look like. And you ask the question, would you continue to move in increments of 25 basis points? Well, the way in which our quarterly projection model is calibrated is that it moves on the basis of 25 basis points, and over the next 12 meetings, it's 25 basis points for each one of those meetings. As we repeatedly state, this is just a broad guideline which changes from meeting to meeting depending on data and our assessment of risks to the outlook. And as such, whether we do 25 basis points, 0 basis points, or 50 basis points depends on our assessment of the risk and the trajectory. There were times when we did 0. And remember, changing the policy rate by 0 is also a decision. So let's get that one out of the way. And you ask about the load shedding and the impact. The forecast that we have had taken account of the load shedding as we have experienced so far. Clearly, if the load shedding becomes more pronounced, it will lead to different challenges. As we stated in the statement that load shedding remains a risk to the investment trajectory, that it creates uncertainty for investors because they need some assurance that you will continue to have electricity going forward for them to make investments. And actually, you raised a question about the fuel price rise, whether it was the key driver. No, it was an important factor, but repeatedly in previous meetings, we highlighted the risks to the inflation outlook. And this was just but one. The exchange rate is the other, the electricity prices are the other, wage settlements is another. There is a range of risks that we had actually identified. And to this now you could add global inflation and global supply constraints that are being experienced, which we are also beginning to see manifest themselves in our own domestic conditions. So the move is not based on one factor, but on an assessment of those risks. And as we say in the statement, the risks are now elevated compared to what we had seen in the previous meetings. How quickly do we expect the transmission of interest rates to come? We work on a rule of thumb of like between 12 and 18 months as the period at which it affects. It is not just that clean, because you may find that you end up having to adjust policy as you go along, as we saw last year, and the effects of that get felt over the monetary transmission mechanism, and which means that if the next meeting is going to be taking place in January, which would be 3 months later, and you are working on 12 months, that means you are looking at a new 12 months for the effect of whatever change that might have taken place in January, if there is any change in January. And what are our expectations of domestic and global demand? At the moment, small open economies like ours have benefited from the favorable global economic conditions. And how has we assessed this? The global economic recovery is not uniform across countries. And when you look at what the key distinguisher is, the key distinguisher had been the rate of vaccinations. The advanced economies were the first of the mark in terms of acquiring the vaccines and vaccinating their populations. And when you look, you will see that the countries that vaccinated early and have vaccinated significant proportions of their populations were able to open up early. And because they were able to open up early, economic activity was able to resume. With that, small open economies like ours benefited from that. We saw that the reopening of the advanced economies also led to a rise in commodity prices, and South Africa benefited from that. But as the economies all reopen and global economic activity returns to what's normality, what you are beginning to see is that commodity prices have begun to fade. Domestic demand had been supported by the measures taken domestically, whether from both the fiscal side and from the monetary policy and financial policy side. The monetary policy stance that we have, even after this interest rate change, remains accommodative. As a matter of fact, the policy rate remains negative on a forward-looking basis. So if you look at our forecast for inflation for next year and where the policy rate is now, you will find that the real policy rate is actually negative. So that deals with the questions. I mean, the good panelists here might want to add anything. Done.
Okay, thank you, Governor. We've got a couple of questions from Bloomberg. The first question is from Pranisha Naidu. Given the current drivers of inflation, do you see the second round price increases materializing? If so, where? The next couple of questions are from Mike Cohen again, also from Bloomberg. First question is, could you please quantify the likely effect the rate increase will have on economic growth? And how would you respond to critics that say this move is effectively removing much-needed economic stimulus? His second question is, how do you view the potential inflationary impact of above-inflation private sector pay increases? Those are all the questions for now, Governor. Thank you.
Okay. Pranesh asked, would the second round effect... Well, we constantly have to watch the impact of the second round effects. We have seen that in the advanced economies, where a view was initially taken that the supply constraints were of a temporary nature, temporary turned out to be longer than what temporary was supposed to be, and we are seeing second round effects feeding themselves through. Now, the thing about second round effects is that you do not have to wait for them to materialize, because if you wait for them to materialize, it's too late. You have to, on the balance of risks, based on your analysis, take a view about whether you think they are materializing. What have we been seeing? Well, we have been seeing that wage settlements are already starting to run ahead of inflation, which says that price setters are starting to say that, well, we think inflation would come out higher. If price setters believe inflation is going to come out higher, through their conduct in changing their pricing, we have got to act to deal with that. We do not have to wait for those second round effects to eventually materialize. The quantification between Rashad and Chris, quantification of the likely effect of these things, there is some rule of thumb that we work on the sacrifice ratios. Any one of you could deal with that. And Rashad, you definitely are dealing with the above inflation wage settlements, settlements and their effect. Chris, you want to start with the quantification?
Sure. Thanks. Well, look, it's a difficult question to answer at this stage because the average growth rate of the economy is slowing at the moment. So we achieved 5.2 for this year. That's our estimate, and next year we will go to a much lower level. So the economy is naturally slowing down as part of the recovery and part of the conclusion of the bounce back in the economy. From a real rate perspective, of course, as the governor noted earlier, there is no actual change in the level of the negative of the real rate, which remains negative even with the adjustment upward in the nominal rate. Of course, a rise in the nominal rate will will increase the debt service costs at a nominal level for some households, and we tend to model that kind of pass-through from 25 basis points to about 10 basis points on growth. But conditions are hard to estimate at the moment exactly what that pass-through to growth would be. Thanks.
Thank you very much, Governor. Let me just be clear about one thing. It's really not the SAB's role to talk about what wages should be. It is not, the SAB's role to discuss the labor share versus profits in a firm. I think that what we look at is whether wage increases are consistent with productivity increases. And I think that from our point of view, what we want to establish is that if wage increases are in line with productivity increase, you don't get the inflationary pressures that we would be worried about that could push inflation above the midpoint of the target. So I think, the clear thing here is people have a right to their wages being increased for cost of living and so on. But I think that what's important for us is not just wage increase in its own right, is how do wage increases impact on unit labor costs? And if it does impact negatively on unit labor costs, it means we have inflationary pressures along with other pressures that exist in the economy, like electricity and so on. Thank you.
Thank you, Governor. I think this will be our last round of questions. I've got a question related to the recent MTBPS. It's from Atwal Dlamini at Alliance News. His question is, what is your comment on it? And does it demonstrate potential to reduce fiscal risks? Then I've got a last question from Pranisha Naidu from Bloomberg. The rand has fallen after this afternoon's decision. Do you think that could now increase inflation pressures? How concerned is the SAB about this? Thank you, Governor.
Fundi, you deal with the rent. I don't know if you have got your gadget with you to monitor the rent on a minute-by-minute basis. It can cause blood pressure. I do not monitor that. What is it? Alliance News, the MTBPS. If you go across now and ask the Minister of Finance what he thinks about the decision we have just made, he will tell you he doesn't comment on monetary policy. I would like to return the favor. I don't comment on fiscal policy.
Thank you, Governor. So just turning to the rand is influenced by a number of factors, both domestic factors and at times also external factors. So the rand is also used as a proxy currency for other emerging market countries. So if there are events that market participants are concerned about in other emerging market currencies, that would have an impact on the rand. As the MPC, we do not respond to day-to-day movements on the currency. We rather assess the effect that the currency movements over a sustained period of time can have potentially on inflation. And that can also, however, be tempered by other factors. So it depends on how much domestic producers and domestic firms pass on those costs that come from an exchange rate depreciation onto their consumers. So it's not as straightforward as the rand is weaker and therefore the MPC will take steps. We assess the risks and we look at whether this is happening over a sustained period of time, and it also depends on other factors as well that also affect inflation. Thanks, Governor.
Did you say that was the last question? Yes. Thank you very much, Sianda. Thank you, everyone, for your attendance. This is the last MPC of the year. There are dates for the MPC for next year. For now, please stay safe, continue to practice those COVID protocols, and have a very restful festive season, and we will see you in the new year.